Good afternoon, everyone. This is Team Dius, and we have researched and developed a solution using open banking that promotes financial literacy among different demographic groups. Team Dius is comprised of Amardeep and myself, Ashiti. So, what exactly is open banking? Well, open banking is also known as open bank data. Open banking is a banking practice that provides third-party financial service providers open access to consumer banking, transactions, and other financial data from banks and non-bank financial institutions through the use of application programming interfaces, also known as APIs. Now, let's take a look at what open banking looks like around the globe. First, being the United Kingdom. The United Kingdom is also known as the world leader in open banking. The United Kingdom made open banking law as early as 2016. The country's competition and market authorities maintain a website dedicated to helping consumers understand open banking. The website also maintains the most up-to-date list of banks currently operating with open banking systems. Now let's take a look at major regulatory standards within the open banking system of the UK. All TPPs must be pre-licensed to request authorizations from the bank institutions. In other words, startups or entities cannot start asking banks for consumer information without having pre-authorized agreements with those banks plus a government-authorized license. What's more is that consumers themselves must give clear consent for each TPP transaction requesting their data per border GDPR requirements. Now let's take a look at what open banking looks like in Europe. The European Union mandated open source bank infrastructure in January 2018. Overseeing this change is the Payment Service Directive 2, also known as the PSD2, a governing body already responsible for managing the European Union's payment service industry. So, what are the major regulatory standards here? Well, as with the UK's open banking legislation, the TPPs can only access consumer information if the consumer gives the direct consent and if the TPP holds open. Open banking is beginning to catch on in the US. The US banks like Citibank and Wells Fargo have rolled out APIs in several customer usage categories, allowing third-party integration with select TPPs. However, many of these are invite-only for exclusive set of developers selected by the banks, such as Inuit's new data accessibility agreement with Chase and Wells Fargo. The major regulatory standards. Open banking is currently encouraged by the Consumer Financial Protection Bureau for US financial institutions, though not mandatory. As of today, 2010's Dodd-Frank Act remains the closest set of compliance standards relevant to consumer data exchange. Now moving on to Asia. Institutions in Japan, Singapore, Hong Kong, and China have led the way in bringing open banking as a service to public. Adopting certain platform models and features from the Europe and UK success cases, these countries lead the way in digitizing financial services in their respective regions. Similar to the United States, many of these innovations have been commercially driven, launched by private banks seeking to corner the market before competitors. Countries like Japan, South Korea, and Singapore have gone one step further with financial regulations creating API playbooks encouraging API developments. Despite its implementation and adoption hurdles, there are clear instances where open banking is moving the needle, both for specific business functions as well as entire industries. The first one is customer experience. Proponents of open banking compare the movement to a supermarket. Consumers will be able to hand-select exact apps and services they want, just like they had hand-selected cereal, salad dressing, and frozen pizza when buying groceries. And the personally curated tech buffet presents numerous advantages to the consumer across their banking and financial planning experiences, including blocked account and identity fraud protection, greater visibility into spending habits and behaviors, instant access to market investments and bank accounts, one cohesive online. The next one is insurance. Insurance lenders stand to use open banking for new insights into secure loan terms and more profitable handling of accounts. Agents can see most complete, dynamic, and up-to-date portrait of an applicant's finances. Using the data, those in the agency can make the soundest lending and insurance decisions possible for both the client's best interests as well as the business's stability and reputation. Open banking's networked accounts also benefit the insurance recipients. On the other hand, consumers have unparalleled visibility over personal spending behaviors and timelines. This gives them better decisions about loans and debt, as well as consumer education on credit scores, interest rates, premiums, and deductibles, and other relevant but most often misunderstood finance and insurance. Now we're finally on to small businesses. Like private consumers, small business owners will have new, rich visibility over the financial realities of business decisions, such as taking out loans for expanding a second location. The information also makes understanding commercial loan payments and terms far more easier, and while simultaneously reducing the administrative costs and subject matter expertise needed to manage such finances. Likewise, business owners can create most practical yet alternative applications possible, expediting timelines on receiving money from lenders and ensuring business needs. Now, the main problem. Lack of financial literacy in different demographic groups due to various factors like age, income class, education, etc. This leads to small debts, which keep mounting up over time. However, there's a solution to this with open banking, but before getting to that, let's look at some statistics. 3-in-1 teens lack the knowledge and confidence in personal finance. Recent studies have found that more and more people are prioritizing their finances and overall financial literacy as a direct result of the COVID-19 health crisis. However, they also lack knowledge of basic concepts, with Greenlight reporting that many respondents have never made a budget or are unable to correctly define what a 401k plan is or do not know if they have to pay taxes, and some of them cannot even correctly identify the difference between a debit and a credit card. Although 86% of respondents reported an interest in investing, the Greenlight survey found that 45% haven't started because they and their parents lack the knowledge or confidence to do so. Almost half of respondents reported having turned to one or more social media site for such information, in particular to YouTube, TikTok, and Instagram. In the UK alone, 12.7 million are financially squeezed. That is 1 in 4 people, meaning they have debt obligations and wouldn't be able to cope if there was a sudden financial emergency. More and more fintechs are tackling the issue of debt, especially in the US, where it's a huge problem. And with better regulations, it seems that open banking could have an essential role. Now, let's take a look at how debt management and open banking are related. From the research team Dius has done, open banking could be a pretty big deal for those who are managing their debt. Here are 3 ways open banking could help with debt management. The first one is credit scoring. More and more fintechs are approaching big companies such as Experian and Equifax and introducing credit scoring into their own products. This means customers don't need to pay an arm and a leg to find out what their credit score is, and they are able to track it more easily and therefore work towards a higher credit score. In the long run, a better credit score means a more favorable APR, lower mortgage interests, and better overall options. The next one is budgeting apps. Now, with open banking, these apps can also help users manage their debt and learn how to get rid of it. Not only does this help people who feel stuck in their debt management situation, but it also builds financial records for those who don't have any. This could be helpful for the individuals themselves or the organizations who may offer financial products. And finally, the third and final one, financial literacy. Sheehan Hawkins from Eccentric says to himself, if you make things more efficient, it makes it easier to reach people who might otherwise ignore their finances. People leaving university with debt might simply think that their finances are bad and ignore the issue. Open banking makes advice more inclusive. By making open banking the norm, bank accounts and other financial institutions can help people in debt aware of their issue and help them pay it off. This could be through better deals as well as more financial control. Now, let's take a look at the following fintechs called Money Advice Scotland and Account Score. First one up is Money Advice Scotland. Money Advice Scotland is a charity that helps citizens in Scotland manage their money, specifically their debt. Recently, they announced that they were launching a web chat service that uses Experian's open banking tool, something called the Affordability Passport. This tool allows the charity to gather data on income and expenses as well as any consumer debt the person may find themselves in. Thanks to this tool, the charity can gather all information needed in a few minutes and offer personalized debt advice. Account Score. Account Score is a fintech that recently launched the first ever open banking solution for people in debt. It is a platform that gathers data from consumers' current account as well as the debt they may be in. This information is then offered to debt advisors who can instantly get a full picture of the client's situation and offer very specific debt advice. All this information will be accessible to debt management advisors who will all be able to offer their own service to help the client manage their debt.
Stakeholders who would be best served by this exact same idea. We come across many different examples of stakeholders, including youngsters, those people in debt, microinvestors, people in governance, money lenders, and also ESG companies, which we will discuss in detail in the next few slides. Through our research, we realized that different jurisdictions and also different kinds of companies had different ideas about how open banking could be best implemented through a system of using a central digital identity. And this is where we went into a couple of our own hypotheses and understanding of what the purpose between digital identity would be in the context of open banking. And so moving on from the idea of creating an open digital ID, we've spent some more time looking into research for what institutions out there did feel comfortable in the implementation of such an idea. Government, healthcare, finance, commerce are just a few examples to be named, and we also include a reference for that. But there are many other different sectors that feel that they would be best benefited in connecting with clients through a digital central ID. This is where Dius comes in as the solution. We and the solution itself would serve as a central platform where people would be made aware of their different spending habits. And this is a simple snapshot of what the exact application would look like, where we have an example of a person, John Doe, who has his financial history along with his debiting, crediting, as well as all his other financial accounts linked to a single central database that would allow him to better tailor his experiences and understand how he can best deal with any debt issues. At the same time, we understand that the creation of a central mechanism would impose many different challenges for security, which is why, taking a few examples from quantum-based technologies, we realized that it would be best to move ahead to a decentralized solution for safety mechanisms. And the purpose behind this is to allow the application itself to scale as more and more people are added to it. The next part of this presentation moves into the other stakeholders that we've identified who would best benefit from a solution that can help them solve debt, and those are for small, medium-sized businesses and also those who are financially illiterate. We understand that the impacts of the pandemic have been extremely intensive on small businesses and medium-sized enterprises, putting them at risk and also creating debt-based economies that's making them difficult to move on to a phase where they can actually start making money for growth and also for evolving into larger businesses. And of course, losses and many other different issues also exist, which makes it impossible for them to avail other kinds of financial instruments, including debts, mortgages, and even loans if they do wish to expand. We do understand that many businesses exist in the market out there that maintain a good environmental record which they can use to leverage and to better connect with micro lenders and other ESG intensive investors, which would be one of the other facets of what Dius would accomplish. Taking in from the idea of green bonds and other instruments that banks from Europe, such as Great Britain and Finland, have used, Duos would also complement with the creation of another facet known as Azure, which would work as an ESG scoring application to connect businesses with other microlenders and investors out there who would want to put their money in the right spaces. Not only will this allow small businesses who are racked with debt to avail opportunities to better evolve themselves and also bring themselves out of debt, but would also allow them to better assess their conditions and apply for other kinds of instruments once they start making positive changes. The application pipeline would work in the exact same way where a small or medium-sized enterprise or even a business would connect with the application, and a team of environmentalists or analysts would assess the company to understand exactly how green it is. This could be based on things like how much waste they produce, how much waste they minimize, how much water they use through their operations, how much electricity do they save. And this information would then be compiled on a central database available to investors who can then use this to better enhance their investment portfolios for what they consider to be green companies. These are a couple of snapshots for the exact same system as we can see over here. Moving on. The solution would be built entirely using, again, a team of engineers, environmental analysts, finance majors, accountants, marketing agents, and legal liaisons who would function as the crux of the application itself. And this would function not just for businesses who want to get themselves out of debt, but also those also on the ESG front. This would also tie in with the gamification idea to allow individuals who are financially literate to better understand how the mechanisms of the market work in order to bring certain businesses out of debt in most ways. These are a couple of the application snapshots that we've included. As you can see, we have a business owner named Michelle who has a portfolio for her own business, who can see exactly how much energy she's saved and what kind of ESG ratings that the system has provided to her, and what kind of credits that what kind of credit-based instruments she can apply for because of her good clean environmental scoring. In conclusion, we understand that there are many different frameworks, but open banking is one that can help indebted individuals, financially literate, and small businesses to better achieve by building on the backbone of a digital identity. There would be many different challenges that come with creating a digital identity, such as safety, which would be best achieved by businesses moving away from a decentralized system to a more distributed style of data management, such as those used by applications like Apache Cassandra. At the same time, this mechanism would also serve as a means for financially literate individuals and small businesses to better connect with lenders, investors, banks, and other people in the marketplace to understand how they can bring themselves out of terrible situations for financial debt or other kinds of issues. Open banking as a whole would also allow them to better apply for other kinds of instruments such as loans and mortgages, while also keeping themselves afloat and keeping them connected to the economy, rather than forcing them to use illicit methods to pay off their debts. And with that, we would like to close the presentation, now opening up for any questions.